Hey everybody, it's Jason Mitrovic with the Realty Firm. We're sitting with Bruce today. We're having another Money Minute here, talking about mortgages, talking about money, talking about houses, talking about the market here in London. Today we're just doing a quick segment on things you should ask your mortgage broker, things you should ask him before you sit down and look for a home, okay? So let's just bang them off real quick. How much house can I afford? Most people, they pick their house, then they call you and they want to buy a house and they're like, oh, I can't afford $1 million home. How do these people qualify for their mortgage? How do you figure out how much they can afford?
Well, I always think people should get pre-qualified first, figure out what your parameters are before you start looking for a home, because that'll save you a lot of disappointment. There's no point looking for a $400,000 home when you can only afford a $300,000 home. The factors that go into affordability is basically your income is critical to that. We're also looking at other debts that you have. So all of your other debts, car loans, credit card balances, student loans, lines of credit, etc. That's all factored into the equation. We're also looking at property taxes. So depending on the type of house, the amount of property taxes gets factored in. If you're buying a condo, we're factoring in condo fees. So it's just based on all of those variables, and based on that, I can determine what your maximum mortgage would be.
Awesome, guys. Some valuable information there. Definitely talk to your mortgage broker before you're going out there looking at houses, just so you know what you can afford, what price range you're looking at. You know, you can always fix up a home, and maybe there's some sort of product that would help you do that.
Yeah, if you're buying a home, there is a product called Purchase Plus Improvement Program that'll allow you to borrow up to $40,000 or about 20% of the purchase price. So it used to be people, basically had to have a line of credit if they wanted to do renovations to a house, but now there's that product available. You would get quotes up front. We would present those to the lender at the time of your mortgage submission, and they would approve those renovations. And basically they're looking for dollar to dollar value. If you're going to put $20,000 into a kitchen, they want your kitchen to be worth, or the house to be worth $20,000 more based on that renovation. So it's a good product for people.
Awesome. What types of mortgage should I consider, and when would each of those apply?
There's basically three types of mortgage. You could have a fixed rate mortgage, you could have a variable rate mortgage, or you could have a line of credit. And each will depend on the client and their tolerance for risk. I like fixed rate mortgages for clients that are risk adverse. You can lock in for a certain rate for a period of time and just forget about it. Clients that are a little more risk takers, they may look at a variable rate mortgage, because historically they've proven that variable rate mortgages, you end up paying less over the life of a mortgage. But if you're going to wake up every morning and worry about whether rates are going to increase or not, then the variable rate mortgage probably isn't for you. We're also looking at the spread between the rates. If there's not a big spread between the variable rate and the fixed rate, then I'd often suggest clients stick with a fixed rate mortgage. Lines of credit are good for entrepreneurs, people that may not have steady income. So it allows you the flexibility to make just interest-only payments 1 month. If you have a good month in your business, you can pay down on your mortgage. So lines of credit are good for self-employed people. And also with the line of credit, you can borrow against your mortgage. So if you've paid $5,000 off your mortgage, you could borrow that $5,000 back and then use that for investment type purposes.
Awesome. Very good. Thank you. So what are the typical costs associated with getting a mortgage?
If it's a high ratio mortgage, and that would be a mortgage that you're putting less than 20% down, there are insurance costs associated with that. So you would use an insurer such as CMHC. They attach a premium to that, and that gets added to the mortgage. So it can be expensive over time. And right now, if you're putting 5% down, it's a 4% insurance premium. So that's something that you need to take into account. Other costs involved in a mortgage would be things like appraisals. If there has to be an appraisal done on a property, then you would pay for appraisal costs. Of course, there's legal fees involved. You're paying both your lawyer plus you're paying transfer tax. So there's those costs to consider. A lot of homeowners would do a home inspection before buying a house. So it's a good idea, especially on older homes, to have a home inspection done, so that there'd be costs for that. Outside of that, there's I can't think of anything else at the top of my head. So.
Excellent. No, it's good. It's good knowledge. I appreciate you bringing it to the table here. So how much down payment do I need to buy a home, especially if I'm a first-time home buyer? What if it's my second house? What if it's an income property?
Okay. First-time home buyers, minimum of 5% down. There's no maximum, but yeah, with CMHC insurance, 5% down, and you can get into a home. If you're buying a rental property, you need to put 20% down. So the rules are different for rental properties. So in that case, you have to put 20% down as the minimum. Now, when we say that, that's using traditional lenders. So I always tell my investor clients, yes, 20% down, but if the numbers work, you might put a second mortgage on a property for, say, 10% down. So in theory, you could buy twice as many houses if you use 10% as opposed to 20% down. So there are some strategies involved, but again, second mortgage money is more expensive, so that has to be factored into the numbers. The numbers still work, and that's an option available to you.
Excellent. If people have questions, they should definitely call Bruce, sit down. He seems like he knows what he's talking about. So credit, how does that affect my ability to borrow? What are some steps I can do to repair my credit if I've unfortunately damaged it?
Yeah, well, credit is a big thing now. That's the number one thing banks look at. Used to be back in the day that they looked at income, and income was the key. Now credit's the key. I always joke with my clients. I say, if my father came to me today and he said, I want to get a mortgage, I'd have to say, Dad, you don't qualify. And he'd probably slap me and he'd say, what do you mean I've paid all my bills for 50-something years? What do you mean I can't get a mortgage? I say, Dad, you have no credit cards, you have no credit. It's just a different world, you just wouldn't qualify today. So credit is the most important thing. So the best thing you can do to maintain your credit is to pay your bills on time, fulfill your obligations. So if you're borrowing money, say on a credit card, pay it off every month on time. If you do that, that'll help improve your credit. Other things you want to look at is your balance versus your limit on things like credit cards. Because as you get close to your limit, it looks like that you're in trouble. You're maxing your credit cards, so that'll lower your credit score. So always encourage clients to never take your limit beyond 60% or your balance beyond 60% of your limit. And that way it won't look like you're in trouble and you're maxing out your score. Other things you can do is don't pull your credit unnecessarily. I always say that, I go to buy a phone at the phone store and they're asking me for my driver's license or my social insurance number, my birth date. The reason they're asking for that is because they want to pull your credit. So I'm, very reluctant to give that information to anybody because I know they're trying to pull my credit. And anytime my credit gets pulled, it could lower my score if you have a lot of inquiries. So that's another thing you can do to try to improve your credit. One other little trick we can do, and it goes back to the limit versus the balances. And I'll give you an example. Let's say you have two credit cards. Both have a $1,000 limit. You have a $1,000 balance on one. You have zero balance on the other. We suggest taking $500 from the one credit card and putting it onto the other credit card. That way you've improved that limit to balance ratio, and your score will improve dramatically just by a simple little trick such as that.
Very good. Awesome. Some valuable information there we can take home. So definitely make improvements to your credit every day. Make sure you keep your limits down on your cards, and make sure to take care and monitor that on a regular basis. One of the important factors you'll need when going to buy a home. Thank you again, Bruce, for taking time to sit with us and chat. Always a good time, always a pleasure.
Thank you very much.